Welcome back to another edition of The Explainer. Today, we're unpacking the absolutely fascinating Q1 FY27 performance of Steel Authority of India Limited, or as we all know them, SAIL. Now, if you follow heavy industries, you know the golden rule, right? Raw production numbers usually dictate market sentiment and ultimately share value. But what happens when a massive company completely rewrites that narrative? Let's jump right in.
Let's start right out of the gate with this massive number, 138%. That's exactly how much sales net profit surged in the first quarter of FY27 compared to the exact same period last year. For a legacy industrial giant, a jump like this isn't just a slight beat, it's a massive leap that immediately catches the eye of anyone watching the market.
Which naturally leads us to the big question. How on earth did they do it? This is where the story gets incredibly interesting, especially if you're analyzing that traditional relationship between raw steel output and share performance. Because, spoiler alert, this massive profit jump happened while their own core production actually dropped, and while global markets were seriously struggling. So to understand this paradox, we've got to look at the broader environment.
Section 1. The global steel slowdown versus domestic resilience. Management flagged a noticeably tough global backdrop in Q1. We're talking geopolitical tensions, disrupting supply chains, and really feeding into inflation. And this brilliantly illustrates the strain. Global crude steel production actually fell by 1.5% in the first 5 months of the year, with China registering a 3.8% degrowth, so the global engine was definitely sputtering.
But in stark contrast to that global slump, India's domestic market showed incredible resilience. While Indian crude steel production saw a modest 3% growth in Q1, domestic finished steel consumption grew by nearly 8%. India is literally consuming steel far faster than it's producing it, creating a highly robust, incredibly hungry local environment.
Okay, let's dive into Section 2, Strategic Operational Shifts, the pit stop.
A hungry domestic market only explains a piece of the puzzle. To really understand why sales, shares, and profitability completely disconnected from their raw output volume, we have to look at their operational strategy. Crude steel production actually dropped from 4.9 million tons in Q1 of last year to 4.8 million tons this year, and sales volume was down roughly 8%. Now, usually, this signals shrinking margins and a drop in share value. But here, as we know, profits skyrocketed 138%. The paradox deepens, right?
Well, the crucial point is right here in management's own words. They deliberately advanced major capital repairs at their IFCO Durgapur and Bokaro plants. They did this, quote, by design during this volatile quarter so they would be free after that and will start producing better in the next quarters. Think of it like a strategic pit stop in a Formula One race. You willingly lose a little time and volume right now, making sure your engine runs absolutely flawlessly when it matters most later in the year.
And while their overall volume took a hit due to this pit stop, they managed to squeeze way more value out of every single ton. They actively upgraded their product mix, knocking down those lower margin semi-finished goods from 14% down to 12.5%. Instead, they focused heavily on conversion, pushing flat products up to 52.7% and long products to 34.8%. It's literally a textbook example of prioritizing quality and margin over sheer quantity.
Which brings us to Section 3, the secret lever, monetizing captive mines.
Now, to truly understand how they engineered such a wildly profitable quarter, we have to look underground. The sheer scale of their captive iron ore monetization is just staggering. Look at this jump. Q1 iron ore sales turnover absolutely skyrocketed from 157 crore rupees last year to 574 crore rupees this year. The physical sales volume jumped from 0.31 million tons to 1.1 million tons.
That smart asset monetization provided a massive profit uplift of around 150 crore rupees year over year, and that's just from higher mine sales alone. And guess what? They aren't stopping there. They have an ambitious internal target of 8 million tons for the full FY27 year. This brilliantly illustrates how diversifying revenue streams within your existing assets can drastically protect and even alter your profitability profile, even when your core steel production takes a planned breather.
And finally, Section 4, Q1 Financial Wrap-Up. Bringing all these strategic decisions together, the intentional pit stop, the product mix upgrade, and the mining monetization, we can clearly see how it translates to the bottom line. Turnover sat strong at 26,010 crore rupees. EBITDA reached a very impressive 4,356 crore rupees, and that profit after tax, the big number we started this whole journey with, landed at 1,636 crore rupees, compared to just 685 crore last year.
through prudent cost management and brilliant operational efficiencies, they successfully navigated what was a pretty tough global quarter. SAIL absolutely proved that sometimes strategically lowering production volume can actually increase profit and fundamentally alter how the market values your shares. It's a complete paradigm shift. With major repairs largely out of the way, a strong domestic market backing them up, and internal mining targets aimed incredibly high, how far can SAIL go in Q2? Will this strategic groundwork continue to yield record-breaking laps for the rest of FY27? Thank you so much for joining me for this explainer. Keep your eyes on the numbers, and I'll see you in the next one.